Real estate investment trusts, REITs, are a type of investment that allows investors to put their money into the real estate market indirectly. These funds consist of a diversified portfolio of properties such as shopping centers, commercial buildings, hospitals, hotels, and other types of properties. The main attraction of REITs is the potential to earn passive income through regularly distributed dividends. How REITs work. REITs are managed by professional managers who buy, sell, and manage properties with the aim of generating profit for investors. When you buy shares of a REIT, you're purchasing a small portion of the properties owned by the fund. The rents and income from these properties are distributed to shareholders in the form of dividends, usually paid quarterly. Types of REITs. There are various types of REITs, each with its own characteristics and investment focus. The main ones are income REITs. Invest primarily in income-generating properties such as offices, shopping centers, and logistics warehouses. Development REITs, focused on the construction and sale of properties. Returns for investors come from the appreciation and sale of properties. Development REITs, focused on the construction and sale of properties. Returns for investors come from the appreciation and sale of properties. Mortgage REITs, invest in mortgages and other types of real estate credit, providing fixed or interest rate linked returns. Hybrid REITs, combine different investment strategies, owning both rental properties and mortgage securities. Advantages of REITs. Passive income. The main advantage of REITs is the generation of passive income. Dividends are distributed regularly, providing a continuous source of income for investors. Diversification. By investing in REITs, you diversify your investment portfolio, since each fund typically owns multiple properties in different sectors and locations. Liquidity. REIT shares are traded on the stock exchange, providing liquidity to the investment. You can buy and sell shares easily, unlike direct property purchases. Professional management. REITs are managed by specialized managers who have knowledge and experience in the real estate market, leading to better investment decisions and higher profitability. Examples of REITs in the USA: Prologis Inc., PLD, focused on industrial and logistics properties, benefiting from the growth of e-commerce. Simon Property Group, SPG, one of the largest shopping center owners, offering exposure to the retail sector. Welltower Inc., Well, specializes in healthcare properties, such as senior housing and medical facilities. How to evaluate a REIT. Before investing in REITs, it's important to evaluate some key aspects of the fund. Property quality. Check the location, condition, and attractiveness of the properties in the REIT's portfolio. Fund management. The experience and reputation of the managers are crucial for the success of the investment. Research the manager's track record and performance. Vacancy rates. Evaluate the occupancy rate of the properties. High vacancy rates may indicate issues with attractiveness or management. Dividend distribution. Analyze the fund's dividend distribution history to understand the consistency and profitability of the investment. Portfolio. Diversification. Funds with a diversified portfolio of properties tend to be more resilient to economic and sectoral crises. Risks and rewards. Necessary caution with REITs. Despite their advantages, REITs also present risks that investors should consider. During the COVID-19 pandemic, many real estate funds faced significant challenges, such as rent reductions and property vacancies. This highlighted the importance of understanding the risks involved before investing. Main risks of REITs vacancy. Risk. Vacancy occurs when the fund's properties remain unoccupied, leading to loss of rental income and negatively impacting dividend distributions. Market risk. REIT share prices can be volatile and influenced by economic, political, and sectoral factors, potentially leading to investment losses. Liquidity risk. Although shares are traded on the stock exchange, liquidity can be limited during periods of low demand, making it difficult to sell shares at a fair price. Management risk. The performance of REITs depends on the competence of the managers. Inadequate decisions can negatively impact the fund's results. Sectoral risk. Some REITs focus on specific sectors, such as shopping malls or hotels, which may be more affected by economic crises or changes in consumer preferences. Rewards of REITs. Despite the risks, REITs offer attractive profitability opportunities, especially in periods of economic stability. The regularly distributed dividends and potential share appreciation can provide significant gains for long-term investors. Success stories. Public storage, PSA. A REIT focused on storage units, which has shown robust performance due to the growing demand for personal and commercial storage. Equinix Inc., EQIX, specializes in data centers, benefiting from the expansion of internet services and data storage. Global investments. International diversification with ETFs and fixed income securities. Diversifying investments outside the USA is a smart strategy to mitigate risks and seize opportunities in global markets. Advantages of international ETFs. Global diversification. International ETFs provide exposure to a wide range of assets in different countries, reducing the risk concentrated in a single market. Low cost. ETFs generally have lower management fees compared to traditional funds. Accessibility. Investing in ETFs is simple and accessible and can be done through brokers. Examples of international ETFs: Vanguard FTSE, All-World ex-US ETF, VEU, provides global diversification with shares of companies outside the USA. iShares, MSCI EF, ETF, EFA, offers exposure to developed markets in Europe, Australia, and the Far East. SPDR S&P Emerging Markets, ETF, GMM, replicates the performance of emerging markets, including Brazil, China, and India. International fixed income securities. Investing in fixed income securities issued by foreign governments or companies is another way to diversify your portfolio and protect against currency fluctuations. Advantages of international fixed income securities. Security. Securities issued by governments of developed countries are considered safe investments. Currency protection. Investing in fixed income securities abroad can help protect your portfolio against the devaluation of the dollar. Stable returns. Fixed income securities provide predictable and stable returns over time. Examples of international fixed income securities. German Bunds, long-term securities issued by the German government. UK Gilts, securities issued by the British government. Japanese government bonds, JGBs, securities issued by the Japanese government. Diversification strategies. Investing globally isn't just about choosing different assets. You need to create a well-defined strategy that takes into account asset allocation. Determine how much of your portfolio will be allocated to stocks, fixed income, real estate, and other types of investments. Periodic review. Regularly review your portfolio to ensure it remains aligned with your goals and risk tolerance. Rebalancing. Adjust the proportions of assets in your portfolio as needed to maintain the original asset allocation, or adapt to market conditions and personal goals. Fixed income in the USA. A solid investment option. Fixed income remains an attractive investment option in the USA, especially in a variable interest rate scenario. With Treasury bonds providing safe returns, fixed income investments offer predictable yields. Main types of fixed income investments. Treasury securities. Securities issued by the U.S. government, including Treasury bonds, T-bonds, Treasury notes, T-notes, and Treasury bills, T-bills. They are considered one of the safest investments in the world. Corporate bonds. Debt securities issued by companies. They offer higher yields than government securities, but also present higher risk. Municipal bonds. Securities issued by states, cities, or other local governments. The yields from these securities are generally exempt from federal taxes and, in some cases, state and local taxes. Considerations. When investing in fixed income credit, risk, assessing the issuer's solvency is crucial to avoid defaults. Duration and maturity. Long-term securities tend to be more sensitive to interest rate changes. Choose a duration that aligns with your financial goals. Yield. Compare the yield of securities with the inflation rate to ensure you're obtaining a positive real return. Example of a fixed income portfolio: 40% in Treasury bonds, security and stability; 30% in high-quality corporate bonds, higher yield with moderate risk; 20% in municipal bonds, tax benefit and security; 10% in short-term securities, T-bills, liquidity and protection against volatility. Financial goals, planning and execution. Setting and achieving financial goals is fundamental to a healthy and successful financial life. A solid financial plan involves goal setting. Establish specific, measurable, achievable, relevant, and time-bound, SMART goals. Current situation assessment. Understand your current financial situation, including income, expenses, assets, and liabilities. Plan development. Develop a detailed plan to achieve your goals, including budgeting, saving, and investment strategies. Execution and monitoring. Follow your plan and make adjustments as necessary to stay on track. Examples of financial goals. Short-term. Build an emergency fund equivalent to 6 months of expenses. Medium-term. Buy a house or a car within 5 years. Long-term. Comfortable retirement at 65 with an annual income of $100,000. Tools to help achieve. Goals financial management apps. Tools like Mint, Personal Capital, and YNAB help monitor expenses and track goal progress. Financial advisory. Financial advisors can offer personalized guidance and strategies to achieve your financial goals. Financial education. Courses and workshops on personal finance can provide the necessary knowledge to make informed financial decisions. Investing consciously and strategically, diversifying your portfolio, and planning appropriately are essential steps to achieving financial success. Understanding the different investment options and associated risks, along with setting clear goals, will allow for a safer and more prosperous financial journey.